A merchandising business sells goods to its customers and must buy those goods from another company. Accounts must understand how to record purchases, returns, allowances, and discounts, which differs depending on what inventory system is used: the periodic inventory system or the perpetual inventory system. In this video, I'll talk about the inventory systems and how accounts record purchases, returns, allowances, and discounts. Merchandising companies like Max Out Sporting Goods purchase goods from other companies, such as the manufacturer or wholesalers, in order to resell those goods to customers. Merchandising companies use a system to manage their inventory, and as I mentioned, there are two types of inventory management systems: the periodic and the perpetual inventory systems. Small businesses often use a periodic inventory management system. Like the name indicates, it means that the inventory is only taken periodically, such as once a year, once a month, or more frequently. Outside of that inventory, the business doesn't really know exactly how much of a specific item it has on the shelves without physically counting the inventory. If the business only sells a few items, it's easy to tell whether the inventory is low, but as the business grows, it becomes more and more difficult. That is why growing and large businesses use the perpetual inventory system, which tracks the inventory with every purchase and every sale and return. For instance, large retailers like Walmart use perpetual inventory systems, and the moment an item is sold, the inventory system subtracts this item from the inventory balance. Walmart's vendors can access Walmart's inventory system and see whether an item is low and new goods need to be delivered. It's a really efficient way to manage inventory. We'll learn first about the periodic inventory system and then later about the perpetual inventory system. The purchase of merchandise for resale is a cost of doing business, and accounts use the purchase returns and allowances, purchase discounts, freight in or transportation in accounts to track those purchases. The purchases account and the freight in account are expense accounts with a normal debit balance. The purchase returns and allowances and the purchases discounts accounts are contra expense accounts with a normal credit balance. All these accounts are part of cost of goods sold, a separate section on the income statement that shows the actual cost to the business of the merchandise sold to the customers. Freight and transportation charges can be a significant part of the cost of buying merchandise for resale. That is why an important topic is who pays for these charges. There are several different shipping terms that you should be familiar with, especially in international trade. These shipping terms are called Incoterms. The most common terms are EXW, FOB, CIF and CFR, and DDP and DAP. They basically explain up to what point in the shipping process the seller pays the cost and from what point on the buyer is responsible. EXW is used when the seller isn't responsible for any part of the shipping charges. FOB plus the city or location specifies up to what point the seller pays and from what point on the buyer pays the charges. CIF stands for cost, insurance, and freight, and CFR stands for cost and freight. In either case, the seller pays for the shipment to the port of destination, and the seller must also pay for insurance under the CIF terms. DDP and DAP are the equivalent of door-to-door delivery, with the seller responsible for all delivery to the buyer. I've also posted a shipping term video in Canvas that provides additional information. Our book only mentions the FOB terms, which means that our examples only mention the FOB terms rather than any of the other terms. So let's talk a little bit more about FOB. When you buy products from Amazon, you pay for the cost of shipping. In business terms, that is called free on board or FOB. That means the selling company will bring the goods to the loading dock, but from that point, the buyer pays all costs. From a legal perspective, it also means that from that point, the product belongs to the buyer, and if there is any damage en route to the buyer, it is the buyer's risk. This is also the point where the buyer is responsible for the sales tax in that city, rather than the city where the buyer is located. There are circumstances where the seller pays the freight charges up to the buyer's loading dock, and those terms are called FOB destination. If the buyer is responsible for the freight charges, the buyer may have to pay the transportation company, or the seller pays for it and includes it on the invoice. So let's look at an invoice and see how those freight terms and other information is shown on that document. After all, accountants spend some time reviewing invoices to determine how to properly record the business transactions. This is the invoice Max Out Sporting Goods received from Modern Sportsman for the purchase of men's compression t-shirts and shorts. At the top of the invoice is the name and address of the selling company, and in the upper right-hand corner is the invoice number. In the next section, we see the name and address of the buying company. In this case, the built to and shipped to address is the same, but for many companies, the billing and shipping address will be different. If Max Out had multiple locations, the invoice should be sent to the accounting location, not to the individual store. To the right of the buyer's name and address are the invoice date, the purchase order number, the shipping company used, which is Speedy Express, and the payment terms of net 30 days. In the next section, we see the order number again. The salesperson field is not populated. The payment terms, the date shipped, which is a day before it was invoiced, the shipping company, and then we see FOB Tustin. Tustin is where Modern Sportsman is located. Next, we see the quantity ordered of 10, the description of the product, the unit price of $476, and then the total price. Since the shipping terms are FOB Tustin, the buyer pays for the freight of $360, which then brings the total price to $5,120. So what does the accountant do next? Accountants record the invoice once the three-way match is performed. Do you recall what that is? That's right. The accountant matches the purchase order to the receiving document and the invoice. If all agree, the invoice can be recorded. Max Out Sporting Goods uses the periodic inventory system, which determines how accountants record the purchase. Under the periodic inventory system, all purchases are immediately recorded as an expense, and only after the inventory determines how much inventory is in stock or on the shelves will the accountant make an adjusting entry to move some of the cost to the balance sheet. Let's record the purchase now. We start by writing the date into the date columns and the account purchases into the description column. The cost of the shirts and shorts is recorded in the purchases account, and the shipping charges are recorded in the freight in account. That is why we debit the account purchases for $4,760. On the next line, we write freight into the description and debit that account for $360. On the third line, we slightly indent and write the accounts payable account into the description column and $5,120 into the credit column, since the payment terms are net 30 days. When the payment is due, we record a debit to the accounts payable and a credit to cash. This is the process for recording purchases for resale. When you purchase other goods that the business uses, like office supplies, office equipment, or software, basically goods not for resale, the freight charges are an integral part of the purchase and not separated from the cost of the product.